There's a dangerous fantasy circulating in the minds of investors right now. There's the belief that the market owes you a second chance. If you are sitting there, cash in hand, hoping for a clean, polite pullback so you can scoop up silver like it's 2019 again, I need you to wake up. The window for bargain silver didn't just close, it slammed shut and the lock has been changed. The trap isn't that silver might dip on a chart. The real trap is thinking that a red candle on a screen automatically means you can acquire the physical metal at a normal premium in normal quantities without massive delays. That is the lesson most people are about to learn the hard way. The fantasy of the perfect entry is getting riskier by the week. We are seeing a market where the odds of returning to old price levels that felt expensive at the time are shrinking mathematically. Remember when people argued that $50 silver was outrageous? Then they bargained for $60. Then they said they'd wait for $70. Now, as prices climb higher, those same people are staring at the board, paralyzed, acting as if they are entitled to a discount. But here's the uncomfortable truth. You do not get to negotiate with a market that smells a supply deficit. And make no mistake, the market is smelling it. We need to analyze what just happened in the price action because it wasn't a sleepy drift. It was a violent wake-up call. We saw a surge where gold ripped higher by hundreds of dollars and silver jumped multiple dollars in the blink of an eye. These aren't tiny corrections. These are the kinds of moves that force market makers to widen spreads and force late buyers to chase. In raw dollars, the move was a punch to the face of anyone shorting the metal. Even when we see an intraday sell-off, notice what happens. Panic sells the dip, and then strength quietly absorbs it. When that pattern repeats drop, absorb, rally it is not a sign of a top. It is a sign of a stress test at altitude. Timing is critical right now because the calendar is working against the casual observer. Price discovery continues even when your local exchange is closed. It happens in global markets, driven by emotion, policy, and currency flows. If you are the type who says, "I'll handle it after the weekend," you are taking on gap risk. Metals do not need permission from the stock exchange to move. When liquidity thins out during a holiday or a long weekend, it sets the stage for moves that look like they came out of nowhere. But they didn't come out of nowhere, but they came out of positioning. This brings us to the most critical concept you must understand to avoid being whipsawed, the tale of two markets. There is the paper market, where contracts change hands on screens. And there is the physical market, where metal must be mined, refined, minted, and shipped. These two markets talk to each other, but they do not always move in sync. When they disconnect, that is when premiums explode. Imagine a scenario where silver dips $5 on paper. You cheer, thinking it's on sale, but when you go to buy, the dealers are out of stock, shipping is delayed 3 weeks, and the premium has doubled. The paper sale didn't save you money. It just gave you the illusion of control. Some will argue that they can just buy an ETF to avoid premiums. Paper exposure has its place for liquidity, but do not confuse a trading vehicle with the asset itself. In a normal environment, the difference is academic. In a stressed environment, the difference is everything. You must decide what job your silver is supposed to do. If the job is to trade, swing, paper works. If the job is to own hard money with no counterparty risk, physical is the only answer. You cannot pretend they are identical when the system begins to creak. Now, pull the camera back to the psychology of the masses. The mainstream narrative loves a specific trick. They claim every rally is speculation, and every dip is proof of a bubble. They run this emotional cycle to confuse you until you do nothing. Because doing nothing is the easiest state to control. But while the media plays games, we need to look at the mechanics of the mining sector. This is where the math gets explosive. Imagine a mining company with a fixed cost to pull an ounce of silver out of the ground. When metal prices are low, their margin is razor thin. But once the price moves past that cost, the margin doesn't just grow linearly, it expands exponentially. It is like a light switch flipping from barely surviving to cash machine. Wall Street is currently ignoring this. They're clinging to old models with normalized prices because they assume reversion. They assume prices must come down. This lag in understanding is why you see days where metals dip, but mining stocks refuse to fall. Smart money is realizing that short-term noise doesn't change the long-term profitability shift. Furthermore, metals are forward-looking. While financial media obsesses over backward-looking inflation prints, metals are pricing in the next chapter. If everything were truly fine in the economy, gold would not be screaming at these levels. Silver would not be acting like gasoline near a match. Gold doesn't wait for an official announcement of a crisis. It moves when confidence shifts. confidence in leadership, confidence in fiscal policy, and confidence in the currency itself. We are watching a slow-motion dilution of purchasing power. When you live in a system where deficits expand endlessly and the solution to debt is always more currency creation, you are being liquidated. Metals are the oldest way to opt out of that liquidation. We hear chatter about price caps and force limits ideas that sound simple but destroy markets. Even the rumor of such interference spooks capital into hard assets. It is a flight to safety, not because everyone suddenly loves silver, but because silver does not require you to trust a politician's promise. Let's address the trade deficit argument. You will hear pundits celebrate when trade numbers improve. But you must ask how they improved. If imports fall because the currency is so weak that citizens can no longer afford foreign goods, that is not strength, that is poverty. If the numbers look better because the country is exporting its gold reserves, that is not a business boom, that is selling the family heirlooms to pay the electric bill. This connects directly to your life. When your currency buys less abroad, your standard of living collapses at home. You feel it as an affordability crisis, but it is really a purchasing power crisis. This leads us to the cliffhanger that ties everything together, the shift in credit risk. If the next big stress event is about government credit rather than private mortgages, the normal playbook breaks. When the problem sits at the very top of the system's sovereign debt itself, the definition of a safe asset changes. If bonds are no longer the risk-free haven, money moves. And when money moves from the bond market, it doesn't tiptoe, it rushes. We're seeing the tremors of this right now. Gold ripping on credibility news. Silver outpacing gold. Volatility clustering at the highs rather than the lows. Do not be fooled by the intraday smacks. A sudden drop that is immediately bought back up is not weakness. It is a transfer of inventory from weak hands to strong hands. It is a heavyweight fight. If a fighter takes a massive hit in the 10th round and is still standing, that tells you the engine is strong. The average viewer looks at a red candle and assumes the rally is over. The sophisticated investor looks at the red candle and asks, who is trapped short? If you are waiting for the crowd to confirm the move is real, you will be the last one in. The media will only tell you it's okay to buy when the easy money has already been made. That is how markets steal opportunity. We are witnessing the early phase of a trust crack. The dollar has been the reserve currency for decades, but used does not mean healthy. A currency can be widely used for trade, while it quietly devalues against real assets. The next phase isn't just about metals going up, it is about institutions repositioning. This is why we see big moves on thin liquidity. It is why miners are starting to diverge from the spot price. And here's a detail that blows the mind. Many gold miners produce silver as a byproduct. When silver rips, it effectively lowers the cost of gold production to zero or better for those companies. Wall Street hasn't fully priced this in because Wall Street doesn't understand why metals are rising. They think it's fear. It's not fear, it's arithmetic. So if your plan is to wait for the perfect pullback, define what you mean. Do you want a lower number on a screen, or do you want a guaranteed chance to secure physical metal? Because those two things are separating. The longer this moves, the wider that gap becomes. The real risk isn't buying and seeing a short-term dip. The real risk is waiting and discovering the thing you wanted is unavailable, or the premium is so nasty that the dip didn't matter. In a regime change, the numbers on the screen are noise compared to the direction of trust. We are moving from a world of paper promises to a world of tangible value. The blow off top is euphoria. This is not euphoria. This is a repricing of the system's collateral. The risk is shifting from will it crash to will I be positioned when it doesn't. Later has a funny way of turning into never. The market is moving. The question is, are you moving with it, or are you still waiting for an invitation that will never come?